All right. Amazing. Hello, everyone. Maybe we'll wait just a couple of seconds as people sort of trickle in. We have a very exciting talk today with an incredible guest. Really, you're all in for a treat. Right. So, as people kind of come in, I want to welcome all of you to the fourth session of the first day of the Modern Investor Summit. So I'm Reda, analyst here at Finimize, and I'll be hosting the session today. Now, before we dive in, I have a couple of housekeeping notes. First of all, if you haven't already, please introduce yourself in the chat with your name and where you're joining us from. Let's all be social. Second of all, just in terms of format, this is going to be a 30-minute fireside chat with time for audience Q&A at the end. So please feel free to add your questions in the Q&A box below. Now, today I am thrilled to welcome our special guest, Meredith Whitney, CEO of Meredith Whitney Advisory Group. Known as the Oracle of Wall Street, Meredith brings unmatched expertise in data-driven market analysis and has a deep understanding of how to leverage data to anticipate big market shifts. Today, Meredith will guide us through some key data analytics strategies that can help investors predict market trends, avoid common pitfalls, and make real-time informed investment decisions. Meredith, it's fantastic to have you with us. How are you doing today?
I'm great. Thank you so much for having me. I'm thrilled to be here.
Absolutely. Well, I mean, we're talking about data analytics today, and I guess my first sort of opening question to you is, what are some of the key data analytics techniques you believe every investor should understand, and how can they start integrating those techniques into their investment process?
Well, I'll take a step back and say that I got into my reliance on data because I came to Wall Street fresh out of college, and I was a history major. So I was surrounded by engineers and math majors. And so I had a chip on my shoulder that I needed to work harder. And that was always a huge advantage for me because I've always worked harder and assumed that I know less. So the data was an incredible source of comfort for me because you can work as hard as you want. You can uncover as much data as you want and be really right because you're data driven, not because an opinion or a instinct drove you there, but because the data got you there. And so I think I have the philosophy, more is more. So I look at government data, I look at company data, I look at Fed, so government survey data, Fed data, bank data, call reports, everything, and then I listen to managements, and then I also look at every industry and gather data points from every industry because you have to be relevant. So in a vacuum, you're going to get into trouble. When you look at things on a broader scale and then have the numbers support that, that's when you can really be successful.
Amazing, thank you. And perhaps I want to rewind a little bit, maybe not a little bit. We're going back to 2008. Obviously, your bold predictions made waves across Wall Street, predicting and, with retrospect, correctly predicting the big market crash and the great financial crisis. So I'm really interested to know what sort of data and analysis of that data made you arrive at that prediction.
Well, the critical thing about back then was the timing was so important. So I always I'm looking for pattern recognition, and that either can be obvious pattern recognition, or I will work the data to find pattern recognition. So in 2006, subprime was beginning to crumble, and I wasn't directly covering subprime because I was covering the big banks at the time, but I was very aware of what was going on in the subprime mortgage market and when that would hit. Or like cognizant of that it could hit, even though Fed Chair Bernanke said it was isolated. The data that I was looking at was increasingly showing me that it wasn't isolated. And there were instances where a big bank, Bank of America, bought Countrywide Credit, which was, amongst other things, a subprime lender. And then Wachovia bought Golden West, a subprime lender. So there were you couldn't take anything in an absolute basis. You had to look at the evolving landscape and what was going on outside of your immediate purview. And because I never feel like I have enough data. I'm always looking for more. Once I find something I feel really confident about, then I will go out on that. I tell people what started that was the report that I wrote on Citigroup. Even though that wasn't the most important report that I wrote during that whole period, I sat on that report for a month before I released it because I was waiting for the Fed to come out and announce whether they're going to raise or cut rates, and that would determine whether how effective my report would be. And so I literally released that the evening after the Fed held its press conference, and the rest is history. But I didn't stop there. I kept on connecting the dots. I wasn't covering the rating agencies at the time, but I effectively covered them because they were so important to the banks, and I needed to understand from a regulatory perspective how dependent the bank's capital was on the ratings of these securities. So it's a never-ending job. It's a never-ending treasure hunt for data that makes you feel confident enough to really put a big position on.
I can only imagine. I mean, I was still in college in 2008, but I'd imagine back then when you came out with your bold prediction, people were perhaps not taking you seriously, challenging you. Of course, you're the one left laughing now. And I'm just wondering, did the challenges and the skepticism you faced during 2008 change your approach at all to analyzing markets and investing?
Well, one of the things that I've always loved about putting my research out there is that when you get challenged and when you get criticism, you get better. So if there was a weakness in my my argument, the challenge and criticism would only make that better. So I'm harder on myself than any critic could ever be on me. So I look at it as as great input. And the fact that one thing that this is where I'm harder on myself. I always because I do things that are usually very outside the box of what Main Street is doing, what consensus is doing. I always try to crazy proof myself. Like, why am I the only one doing this? Why was I the only one doing what I was doing before, during, and after the crisis? And that never made any sense to me because it was all publicly available data. But oftentimes people look at data or information inside too short of a time frame, too short of a vacuum. And I think the wide scope that I bring has helped me. And so everything is cumulative. So I've only gotten better since that time. In 2007, 2008, I was certainly better than when I was in my 20s in 1997, 98, when you had the Russian collapse and so much market turmoil, small by comparison. But every year you get better.
Absolutely. And, kind of looking back at the past, 3 sort of 4 decades, one thing that has really changed in investing in markets is just availability of data, right? Long gone are the days where stock analysts would camp outside Macy's and count the number of customers going in and out and so on. But I guess with that, now huge availability of data these days, just everywhere you look, easy to access. How do you kind of, separate what's noise and what's, reliable and actionable for investing purposes?
Well, you end up having your own blender through which you can blend the data, and so there's stuff coming at you all the time. And I don't, there's stuff that I rely on, which is specific consumer spend data, and that comes from a company that processes all of the transactions for all the major merchants in the United States. So I rely on that. I've relied on that for 20 years. Survey data, government survey data, I use, but I hardly rely on that because I think what has changed over the last 30 years is it's increasingly unreliable because most people don't have a landline. B, most people under 40 are not going to answer a phone number that they don't recognize, and C, most people don't really want to respond to a survey. So the survey data becomes less and less reliable. I use it as a reference point, but I use hard data. I rely on that much more closely. I mean, 20, 30 years ago, 30, 40 years ago, maybe government survey data was all that was available, or primarily what was available. But today there's so many more resources, and I think you just find what works for you. I clearly know, and also I compare and contrast data that I'm getting from macro data to company specific data to management commentary, and then determine where I want to go with it. So I don't just listen to bank earnings calls. I listen to a whole host of industries earnings calls, because that all comes back to the financial services world.
Absolutely, and everything, I guess, is a lot more interconnected than people believe, right? That's something I've kind of learned with time.
Yep.
In our discussion, we're talking a lot about data, and presumably a lot of what we're talking about in terms of data is quantitative data. So I'm just trying to understand how you balance, analysis of quantitative data with taking into account qualitative factors when it comes to your investing, trying to predict market trends, and so on.
Well, there's some data that you have to sort of take a leap with. So, there's a lot discussed about the K-shaped economy in terms of in the United States, where a portion of the economy is doing incredibly well, and over 50% of the economy is doing very poorly. I don't, a lot of the retailers won't be able to explain to you what has happened. Some may, some don't. So I have a major thesis, and then I juxtapose it to what I'm hearing from qualitative commentary. But it's always going to be the quantitative that will be the most important. But you can't not pay attention to qualitative data.
Amazing. And perhaps this is a follow-up on that. So do you, discretionarily look at qualitative data and kind of factor that into your investing? Or do you try to take qualitative data, try to convert it into something quantitative, and then analyze it that way?
Well, first and foremost, I don't need to be right. So if I don't see something, I'll pivot, because it's not a question of me proving myself right. I just want to get to the right answer. So I'll give you an example. We have been negative up until this week on the dollar stores, and the dollar stores for the last 18 months are down between 50 and 65%. And something I was listening to the dollar stores, I guess it was the second quarter of 2023 call, and they said something about this would be our first year anniversary without COVID stimulus. And it made me think that makes perfect sense for their consumers. So then I started to look at BLS data, and what was clear was you saw a dramatic drop off in after-tax earnings for over 50% of the households in the first year, which is 2023 fiscal year, that they had absolutely no COVID stimulus. So in fact, most or over 50% of U.S. households were worse off than they were 4 years ago, and that wasn't going to change. And so the dollar stores, I thought, would be pressured for the near medium term. But that changed the way I look at everything else. So I'll listen to qualitative data from American Express when they talk about their millennial and Gen Z customers, and then I'll go back and look and compare them that they're spending to boomers, and the fact that they've been spending at a rate 5 times that of boomers. And then I go back and link it to the fact that the lower part of millennials and Gen Z, which I call the avocado toast generation, primarily don't own homes. So they're unburdened by the high cost of owning a home, paying for property insurance, paying for the skyrocketing cost of homeowners insurance, et cetera. So I can see where there's strength and weakness, but that could be triggered by something qualitative I hear, and then I go back and dig into the data, and then that leads me to somewhere else. But then I love this conversation because this does not seem like work to me. This is absolutely fun.
Amazing. And kind of also one question on, in terms of leveraging real-time data, obviously things are changing a lot. How do you effectively do that without falling into the trap of constantly overreacting to short-term fluctuations in the data?
Well, I can see how it's easy to do that because the market gives you every opportunity to feel wrong and wrong. It's a daily knife fight. But uh, you know, because I put so much work into my thesis, and I've got so many I've got so much foundational support behind it. I have high conviction, and I don't say anything or talk about any idea that I don't have high conviction over. So once I get to that point, I'm steadfast and I'm undistracted. And I think that's really important because there is so much noise that comes at you. But, that also comes with age and experience. But throughout the crisis, I mean, I think probably once I got out of my 20s, I was a lot more confident, and because I had been through several cycles then, and that just only gets more so. So I really don't get distracted.
Amazing. Thank you very much. And one last question before we move on to audience Q&A. And for everyone tuning in, if you have any questions to Meredith, please don't forget to put them in the Q&A box. So Meredith, we've talked a lot, obviously about the present. We've talked about the past in 2008. Maybe just a quick one in terms of the future, and how do you see things changing within data analytics and how that's going to impact investing in the future? Obviously, a lot of talk about AI, et cetera, et cetera. What are your thoughts on that? What are your thoughts on kind of future trends within this particular space?
I think I use AI all the time, but I don't rely on it. I use it for ease of business, right? So I'm very grateful for AI, but I would never overly rely on it because the way they're processing information and data is unique to whatever coding they're doing or how it's being driven. The way I process data is very different. So I don't know that I change that much. I think that I hope it doesn't mean that people get lazy and over rely on AI, because hard work is worth it. And so I think it'll make some things easier, but you have to do your own work. And if you want to have real conviction in what you're doing, and have real conviction in the long-term thesis that's going to drive your investments.
Makes perfect sense. Thank you so much for that, Meredith. I want to move on now to audience Q&A. And we have a first question coming from Daniel. Do you have any concerns about the extremely high valuations in the US market right now? And how is this different from the dot-com bubble?
Well, the dot-com bubble was driven by a lot of companies that weren't making money and had no prospect of making money. It was the ultimate silly season in investing. And I say that because you had companies valued off of the revenue they got from banner ads. Sorry, I'm really dating myself. But there were companies that had high valuations at the time that have gone on to have incredible success, and the case in point would be Amazon. But it depends on what you think the growth prospects of a sector and a stock is, and there has got to be secular momentum behind it to justify high valuations, because the idea behind that is that earnings are going to continue to be guided upwards, and you can't think that one mistake that so many people made in the dot-com bubble was, and they hopefully don't make during this, is I don't understand, but I'm going to do it anyway. Other people must be smart, so I'm going to follow them. You have to do your own work, and you have to really understand what you're investing in. Not everything is incredibly expensive, but a lot of things are expensive. I think for the sectors that I'm looking at, I think there's strong upward bias to earnings, and so I'm not as thrown off by valuations. And I also think that the capital markets will continue to open up, and that'll provide a lot of support for the valuations in my world. But I don't talk about things that I don't know about, so I can't really talk about the tech sector or Please don't ask me about Bitcoin. I mean, that's not my area where I feel comfortable in talking about. In my world, the valuations don't scare me.
Amazing. Makes sense. Thank you very much. Our next question comes from Alessandro, who starts with a dark quote by Darrell Huff from 1954. If you torture the data long enough, it will confess to anything. How can someone who is not an expert like you make sure they can get the data right?
Oh, well, it just takes time. So, when I first started out, when I was 22, 23, I didn't know what I was doing. And I couldn't recognize, I had a low ability to recognize patterns. And that comes with time. So you just keep at it and take a deep breath and see if the data can tell a story. And so this is where my history major comes into in handy, because everything is about a story. Everything about and cycles tend to repeat themselves, not exactly, but I expect a lot of liquidity to come in the market. I have a series that we've been publishing, Party Like It's 1994, and so it reminds me very much of the 1994 market in financial services when stock prices exploded. So it just give yourself a break and just start doing it right now, and then try to bring in as many data sources as you can to learn, and then develop your pattern recognition, and maybe create scenarios and watch them for a while before you act on them, but it'll come.
Amazing, thank you. And next question comes from Amki, who's basically asking, what are your main basic rules for determining the quality of data and knowing whether the data is reliable or not?
Well, I'll give you an easy one where the data is not reliable. This was certainly the case for Citigroup in 2007. So they constantly re-scrambled the egg. They constantly were restating numbers. So you couldn't find trend lines. You couldn't do pattern recognitions. And I think what was unique in what I did was I just completely boiled down the analysis to balance sheet leverage, because the income statements segment reporting can change all the time, but your balance sheet information basically stays the same. So you have to find an area that is so if the disclosure and the reporting changes all the time, then that's a red flag. I'll give you an example. Bureau of Labor Statistics changed the way it reported data this past September, and I basically used some of it, but threw out most of it because there was no apples to apples comparison. They made it incredibly hard. So if you have the same type of reporting, the same type of data where you can draw long-term analysis. So a lot of economists look at a number, a reported number versus expectations versus revisions. I look at a much broader, longer time series, and that gives me my pattern recognition. So take your time series out as long as you possibly can. If you're looking at, Fred, the St. Louis Fed, has great data that you can download. It has incredible time series in it. So just find what you're looking at and make sure it is consistent across reporting series.
Amazing, thank you. And our next question comes from Radi, and I have to warn you, Meredith, this might sound like blasphemy. So he's asking, what would it take for you to forget your data-driven approach? Were there cases where you felt like data failed you?
Data has never failed me. Data's never failed me. No, I don't think that I don't presume that, what's in my head is always going to be right. I need more support than that. And I get that from the data. Sorry, Roddy.
I mean, as the saying goes, the data is the data, right? And
the numbers don't lie.
The numbers don't lie. But Radi has another question, much less blasphemy in this one. He's basically asking, to really fully benefit from data, you need a lot of real-time data, which can be very costly. How can you deal with this?
Well, I mean, I don't always use necessarily real-time data. I mean, I've got the benefit of Bloomberg, which is one of the greatest technology, financial services models ever, and that consolidates so much information. So where you don't have that, you have access, just as I said, to Fred at St. Louis Fed. All that data is free. Most of the data I use is publicly available data. All the SEC documents are free. What you may not get would be, some of the sources, but and you may have dated, they may be somewhat dated, but that shouldn't hurt you. And obviously, everyone has access to public company financials and transcripts, and I wouldn't think that would hold you back too much.
Amazing, thank you. And then we have a question from Amit, who's basically asking, was there a major situation where you or your team failed to spot a particular signal or market trend from the data and only realized it much later on?
I'm so scared of that. Surely there are things that we miss, but we catch them right in time. And then we have an incredible network of really smart people that we talk to that will point out something that we've missed. I'll give you an example. There's economist Anatol Kaletsky, who has been a friend for 20 plus years. And I know him through Louis Gave and his father, Charles Gave. I tell this long-winded story because I was having breakfast with him in February of 2009. And he pointed something out about a government, about the Fed buying agency paper. And I went back to my off, and that was on my radar screen. I went back to my office and went through the Ks were coming out. And sure enough, all the banks had been loading up on government agencies. And that's what recapitalized the banks in 2009. So I went from bearish on the banks to neutral. In retrospect, I should have gone bullish on the banks because they were riding their capital all the way back up through having a big buyer behind them. They'd buy the securities, and then the Fed would drive the market up for the securities so they could write up their balance sheets. So surely you're going to miss things all the time, but you get there eventually, and with a lot of times with the help of some friends.
Absolutely. Thank you very much. And then we have a question from Alejandro. I know, Meredith, you provided a lot of examples, but perhaps we can share, one more example on data that you used that led to a successful investment decision.
Okay. I'll tell you recently, because a lot of this we're talking about it from the crisis. In October, it was clear to me that private equity was coming, and private credit was aggressively entering the consumer finance space. And there were several announcements that there were going to be forward purchase agreements with a lot of the originators because there's so much demand for yield and so much demand for dollarized assets. So I had been negative on SoFi for about 18 months, and then I flipped and went very positive on SoFi because of all the liquidity that was going to come in and buy their loans and basically erase any worries over credit quality. The stock's up over 65% since October. So again, I look at a lot of different things. I lived through that in the 90s. That's part of the Party Like It's 1994 series we do. But that's a real time example of using data.
Amazing. And that's a great example and a great way perhaps to end, because I'm afraid that's all the time we have for now. Meredith, on behalf of myself, Finimize, the entire Finimize community, and everyone attending, thank you so much for your amazing insights. I certainly learned a lot and took a lot away from all of that. So thank you so much for your time.
Thank you so much. Great questions.
Thank you. And thank you everyone for tuning in. I really hope you enjoyed it and took something away from the session. As I said, I certainly did for sure. Don't go anywhere just yet, because our next session on alternative assets starts in about 15 minutes. So thank you very much once again, and see you at the next session, and have a great day.